So picking up where we left off in the previous video, we're talking about the events that occur that could have an effect on the value of our PBO, the value of our pension liability. So we already walked through service cost and interest cost. We said that over time, the liability is going to increase because each additional year that the employee works, we owe them a little bit more. So that's service cost. Also, each additional year that the employee works, they should have had money in their pocket in the previous year. So all along, they should be accruing a certain level of interest on the money that we owe them. That's what we called interest cost. We then talked about prior service costs, saying that if we decide to change the pension formula. So the example that we went through is that instead of having 1.5%, we had 1.7% used in our pension formula. We decided to change, we as the company decided to change that pension formula, and therefore we increased the liability because we went from 1.5 to 1.7%. That was called prior service cost. The fourth item that's going to have an effect or change the value of the liability is related to gains and losses. So think about when we first started this conversation about defined benefit plans. We said that there are a lot of sort of unknown elements to a defined benefit plan. We have to make estimations about a lot of different things. We have to estimate how much that person is going to earn in their final year before they retire. We have to estimate how long their retirement period is going to be. We have to estimate the discount rate. We have to estimate a lot of different things. We have to estimate how long they are going to be working for us. We have to estimate a variety of different things. And so what happens is sometimes those estimations change. So just like, we make an estimation to calculate depreciation expense. Sometimes over time, we may have to alter the useful life of the asset, or we may decide, okay, straight line's not the best method. We should be using accelerated depreciation. We change that estimation and it creates a difference in our depreciation expense and our accumulated depreciation. Same thing goes here. If we decide to change one of those estimations, and typically that will be done with the advice of the actuary. So we mentioned in a previous lecture that the actuary is going to be an expert in sort of statistics and mathematics, and they're going to give us, based on their data analysis, they're going to be able to give us these estimations. If that actuary changes their estimation on any of these things, it's going to create gains and losses. It's going to create a difference in the value of our PBO, in the value of our liability. So there are actually two examples that are presented in the Excel lecture. In these videos, I'm only going to go through this first example. So we're going to go through example number one, but just know that in the completed version of the Excel spreadsheet, which is already uploaded in Moodle, in the completed version, and actually I can even show you here, in this Excel spreadsheet, you can see at the bottom, the tab PBO gain loss, and then there's PBO gain and loss number 2, right? So in Moodle, there is a completed version of this second example. We're not going to walk through it. The process is identical. It's exactly the same as what we are about to do on this PBO gain and loss tab. So you can look at that as an additional example of what could happen with these estimation changes, how it can create gains and losses, and how it can create a change in the value of our liability. Okay, so the example that we are going to go through in the video is going to be example number 1. So we are going to assume that the estimate of future salary actually increases by 5%. So if you think about our original set of information, right? We said that we believe that Jessica Farrow in her last year before retirement is going to be making $400,000. What we are now altering about that is we are going to assume that she's going to make 5% more than that. So if we took, and I'll do the calculation just so you can see, if we took her original estimated future salary and we multiplied by 1.05, that's saying that we want to take the full amount and we want to add 5% to it. That gives us a new estimated future salary of $420,000. So we have to change that estimate of future salary in our calculation. Just as a reminder, we already, in both of the previous videos, we already went through the initial calculation of the PBO for 2019 using our initial information. And we said for step 1, we came up with retirement benefits of $600,000. Step 2, we said the present value of those retirement benefits as of her retirement date, $688,195. And then step 3, the value of that liability on at the end of 2019 is $119,821. So that still remains our sort of baseline of this example. Notice also that I included a timeline already in the top of our Excel spreadsheet. So you can see how we, I actually didn't write this, but her hire date is where we start, and that's 2010. We said that she has worked 10 years so far. She has 30 more years to work, and she's going to be retired. So this is her retirement period. For 20 more years, we said we calculated that the benefit that she's going to be getting, that periodic salary payment, is $60,000 a year. And then so on and so forth. We brought it back to where we have a $119,821 liability at the end of 2019. So just like we did with prior service cost, the first phase of this implementing this change is let's figure out what the 2019 liability would be. So again, this is as of 2019. This is also going to be as of 2019. What would the liability have been now that we're changing our estimate of this future salary? Instead of using $400,000 in our estimate of future salary, we're going to use $400,000. That's going to be a change that we make to this first step. So as of 2019, we're going to estimate that her salary in her retirement year is $420,000. She has worked 10 years so far as of 2019, and our percentage is still 1.5%. Again, we're looking at each one of these examples sort of singularly, so we're not making any additional changes to the pension formula the way we did for prior service costs. So it's just the one thing that we're looking at, the one change is just the estimate of future salary. If we do step 1's calculation, $420,000 times 10 years of service times 1.5%, we have a new estimate for how much Jessica Farrow is going to be paid in her retirement period. We are now saying that that cash outflow is going to be $63,000. So now we need to go through the same steps that we went through when the retirement benefit was estimated to be $60,000. We need to first do a calculation that's going to bring that $63,000 annuity amount to her retirement date. So step 2 is going to be that present value calculation equals PV. My rate is 6% given to me in the problem. My number of periods, how many years is she expected to be retired? 20. My payment amount, my new payment amount, negative $63,000 now that we're using this new updated salary amount. Future value 0. Type 0. So what I'm seeing here is that the total value of that annuity as of her retirement date is $722,605. And then step 3, I need to take that calculation and I need to bring it back to 2019. So one final present value calculation equals PV. My interest rate, again, is 6%. My number of periods, how long is that time period from today and her, or, you know, sort of what's the lapse in years between her retirement date and 2019? 30 years. Payment amount, we have no payment amount because right now what we're doing is figuring out what the present value of that $722,605, that future value, that's what we're bringing back to the present. And my type being 0. I get $125,812. If I compare that to my initial value of the PBO, $119,000, if I compare those, I see that my liability is increasing by $5,991. So, because my liability has increased due to this change, due to the estimation change that now we're looking at a salary, an estimated future salary of $420,000, because of that, we are seeing that the liability should increase by $5,991. That is going to be considered a loss. Anytime that you make an estimation change and it creates an increase to your liability, that's a loss, right? And then the opposite will be the case for the second example, right? In the second example, what you'll find when you look through that on your own, what you'll find is that the change in estimation actually decreases the value of the liability. If we are making an estimation change that makes the value of our liability go down, that's good for us. That's a gain because we owe that person less money. Our liability is going down. Okay, but for this case, what we're seeing is that the liability is increasing. So when we go to record that in a journal entry in 2020, we want to keep that in mind because that $5,991 represents a loss, and we want to record it appropriately in our journal entry. Okay, so as we did previously, the next thing that we need to do is figure out what all these calculations are as of 2020. So we're moving our timeline to 2020, which is going to make it so that our new period, our new service period is going to be 11 years instead of 10 years. And our period of time between her retirement date and the year 2020 is going to be 29 years. Oops. 29 years. And then let me fix this. Years. Okay? So we're altering, not only are we going to use, right, this new $420,000 in our formula for 2020, we are also going to say that her service years are now 11 instead of 10. It is 1 year later. This is as of 2020. So because it's 1 year later, we have one more year of service. And then again, 1.5% is going to be the percentage that we use. So now we need to do this whole thing over again. And what we're going to do is figure out as of 2020, given the updated future salary of $420,000 and the fact that she's worked one more year, what is our new estimate of those future benefits? $420,000 times 11 years of service times 1.5%. We are now saying that this annuity amount is, whoops, I want that to be green, $69,300. That's the amount that we are saying that she is going to receive in her retirement period. We now need to go to step 2 where we bring that to her retirement date. So again, a present value formula equals PV. If I take the rate of 6%, number of periods is still 20. That's how long she's expected to be retired. My new payment amount, negative this $69,300. My future value is 0. My type is 0. And that gives me a value of $794,865 as of her retirement period. And again, we know that's not good enough. We need to bring this back to 2020. That's the next and final step to this process. So, equals PV. My rate is 6%. My number of periods now, instead of having 30 years that we need to bring this back, it's only 29 years. She's worked 11 years. That means she only has 29 years left. We don't have a payment amount because right now we're focused on this future value of $794,865. My type is going to be 0. So what we are now saying is as of 2020, the end of 2020, the liability related to Jessica Farrow's defined benefit plan is $697. I'm sorry, $146,697. We know that if we look at what it is today in 2020 versus what it was in 2019, the total change, the total increase in the liability is $26,876. And now again, we have to not only recognize that there has been an increase, but we have to understand why. The reason we have to understand why is because number one, we have to make a journal entry for it. And number two, all of these details need to be disclosed in the footnotes. So we have to understand that yes, it has increased by $26,876, but why? What are the causes of that increase? Well, we already said that one of the causes of that increase is that we had a change to one of our estimations. We had been estimating that Jessica Farrow was going to make $400,000. Now we're estimating that she's going to make $420,000. That caused our liability to go up by $5,991. Again, that's why it's very important to isolate this set of calculations here. Because if you isolate this set of calculations here, you then understand why the liability has changed just because only looking at one thing, only looking at the fact that we changed the $420,000 estimated future salary. So again, the liability is increasing by $26,876. We need to know why. Reason number one is that we had a change in one of our estimations that's going to be reported as a loss, and it's a loss of $5,991. We also know that because Jessica Farrow should have had $119,821 in her pocket all along, she should have been earning 6% on that amount. We have interest cost totaling $7,189 in her that is accounting for part of this change. So again, because she should have had $119,821 in her pocket all along, we know that interest cost is going to be $7,189. And then lastly, if we know that the total change was $26,876, and we know that the loss was $5,991, and we know that interest cost was $7,189, what we can say is whatever is left over from that total change, that is what we allocate to service cost. What we're saying is Jessica Farrow worked one more year, therefore the liability goes up because she has worked one more year. That's service cost. Okay, so again, we not only need to understand the total difference, we have to understand why that difference appears in that way. Why did it increase? And we can break it down amongst these different items. What we know in our journal in 2020, what we know is that the pension benefit obligation is going to increase by a total of $26,876. We know that. We also know from previous lectures that the total amount of interest cost and service cost is what we are going to include as a debit to pension expense in our journal. And again, I'm just going to change the formatting of this quickly. So again, we know that the total interest and service costs both get recorded as a debit to pension expense. And now we have this $5,991 amount, and that is going to be a loss, but very similar to what we did with pension cost. We are going to report that loss to an account called, I don't want to do that, to an account called Other Comprehensive Income. So OCI stands for, OCI stands for Other Comprehensive Income. And just like we discussed with prior service cost, Other Comprehensive Income is an account that we use when we have these abnormal types of effects to our defined benefit plan. So it's not going to be really as often that we change some of these estimations. It's not something that's going to happen every single year, right? And even if it does, the idea is that this doesn't reflect anything about, sort of the baseline underlying liability that we have to Jessica Farrow because she has worked for us. It's these things that are sort of out of our control, these estimations that we really don't have control. We just have to simply go with what the data tells us in terms of all of the different estimations that we're using. So because we essentially don't want these gains and losses to have a direct effect on our income statement through pension expense. What we do instead is report them as a loss or a gain, that you're going to see a gain in the second example, in other comprehensive income. It's just a series of gains and losses that don't necessarily have to do with sort of the normal everyday course of operations for our business, but we do have to acknowledge that they have occurred. These gains and losses have occurred. We don't want to put them in our regular everyday net income calculation, so we got to put them somewhere. We put them in other comprehensive income. So we have now worked our way through 4 of the 5 items that change the liability balance. The 5th and final item, here's additional information about gains and losses. So if, before we get to the 5th and final item, still talking about gains and losses, if a revised estimate causes the liability to be lower than we previously expected, if the liability is going down, that's going to create a gain. If the liability is going up, that's going to create a loss. So that's, again, what we discussed already. So the 5th and final item or event that's going to cause the PBO, it's going to cause the pension liability to change, is very simple. If we pay out retirement benefits, that means that our liability is going to decrease, right? So we have said all along, all of these complex calculations that have an effect on our liability balance, this one's real easy. All we're saying here is if we start to make payments to those retired people, then that obviously is going to make that liability go down. We're going to debit in our journal entry the PBO, the pension benefit obligation. So this one, there's no calculations involved. It's simply how much money did you pay out to your retired people? If you paid that money out to them, then just like any other liability, you don't owe them that amount anymore. So your liability should be decreasing with a debit in your journal entry. One thing before we kind of move on to the other aspects of a defined benefit plan that I want to mention is you can see here that the credit is not simply to a cash account, but it's a very special cash account. So at the beginning of one of these lectures, we discussed the fact that there are, and actually let me go back to that slide. We discussed the fact that there are 3 overall items that we are going to talk about when it comes to these defined benefit pension plans, right? The liability is what we've been talking about all along. We haven't really gotten into the plan assets or the periodic expense too much. We've talked about them here and there, but what we are moving into in the next couple of videos is going to be talking about plan assets and a continuing discussion of the periodic expense. Here is the first piece to that. Okay, the first piece to that is that if we have a set of funds that are set aside and their sole purpose is to pay out retirement benefits, that those accounts are called plan assets. It's not just an everyday operating cash account, it's a plan asset cash account. It's designated, it's earmarked to pay out these retirement benefits. So when we decide, or not when we decide, but when the people start to retire and we have to pay out the benefits that we promised them, we pay them out of this plan asset account. We don't use our general cash account. We have set aside designated earmark funds, and over time we've accumulated enough in that account so that we can start paying these people out. When we start paying them their retirement benefits, we will use that plan asset account to account for that. So here is a summary of all of the different components that are going to change the pension benefit obligation. We've gone through each one of them with an example. Again, the easiest one being retirement benefits.